With new tariff threats kicking in on August 7 and fragile economic conditions ahead, markets could see sharp declines next week. As we already saw last Friday, the markets took a pretty nice dip, but it proved to be a good buying opportunity, but there is possibility of further dropping in the market. And ULTY's strategies, most notably the protective puts, offers clues on how to manage risk. And while ULTY will still follow the broader market, its downside losses may be cushioned thanks to its hedging tools. And in fact, let's analyze how it's performed compared to S&P 500 as well as the NASDAQ indexes last Friday. So we can see ULTY has dropped 2.12%, but we do have to note that it is up 0.49% in the after hours. And if we compare it to the S&P 500 or SPY, it's down 1.64%, and pretty much down only a little bit in after hours. So compared to S&P 500 index, it is down a little bit further. But if you wanted to do this calculation with factoring in the after hours movement, which is plus 0.49%, it's actually down less than SPY, which is absolutely crazy to think about. And that in turn is why those protective puts that ULTY has set into place is really smart of them to do in an ETF as high volatility as this is. Because remember, the holdings in this ETF are very risky, they're very volatile in order to get the most premium possible. Stock such as MicroStrategy or Reddit is going to have higher volatility compared to something like Coca-Cola or Apple. So that's what this ETF is all about, choosing high volatility stocks in order to pay out the most premium possible. But with volatility, you're going to have a lot of risk, downside risk, and to help mitigate that, they are using protective puts on the underlying holdings. So if any of these underlying holdings end up dropping, say for example 50%, you're not going to see that 50% loss in ULTY's share price. Those puts are there to protect you. Now you are going to see some significant loss, but it's not going to be destroying your entire portfolio. But we can't count out these tariffs and the August 7th deadline, which is just next week, which could tank the market even further. Now we're not going to get into too detail with politics here, but it is going to have a big effect on volatility. And that's actually a good thing for ULTY, which is an ETF designed to capture that volatility. But you should still protect your overall portfolio as there may be some bad stuff ahead. No one really knows. And while ULTY isn't immune to stock declines, its losses may definitely be dampened due to those protected puts, as well as offering income while the markets dip, which is the main focus of this ETF. It's an income ETF. But these dips do provide a very good buying opportunity to get more shares at a cheaper price, which we saw a lot of people do on last Friday. And even in my own portfolio, I picked up more shares of ULTY, MSTY, as well as SPY and QQQI. But we should understand how protective puts work and how you can implement your own protective puts on your underlying holdings, just like how ULTY is hedging its positions. So if you head over to your options chain on whatever brokerage you're using, you want to select buy and put. And for the expiration date, you can choose whatever date you want. Preferably about 30 days is usually what people like to do. For this example, we'll just choose the August 29th expiration date. Head down to the options chain and you want to choose an out of the money put option. Now what I like to do is to choose something with a 0.2 to 0.3 delta. And if you're not familiar what delta is, it's basically the expected price for the option. That's how much it's going to change in price for every $1 change in price of the underlying asset. In this case, it's going to be SPY. So if SPY drops by $1 and goes to $6.20, the options price for this particular option right here is going to drop, or is going to increase rather, by about $20. 20 cents times 100 is going to be $20. So the total value of this contract is going to be $454 approximately. Because remember, buying a put option, or known as protected put, is a bearish position. And if you're not familiar with put options, it's a contract giving the option buyer the right but no obligation to sell a specified amount of an underlying security at a predetermined price within the time frame. So if we have shares of SPY, say we have 100 shares of the underlying, and August 29th comes around and the S&P 500 or SPY is at, as an extreme example, $500 per share. That is going to be a huge loss in your portfolio, going from 621 all the way down to 500. But if you have that protected put in place, if you've bought it for $434, the total cost you're seeing is the cost for one share. Multiply that by 100 shares, because each contract holds 100 shares. It's going to be $434. At expiration, if SPY is $500, you can sell your shares for $596 if you have this put option right here. So you can easily think of put options as insurance, as you would with car insurance, home insurance, and it's a way to mitigate your loss, especially when the market crashes or in extreme downturns. Now, of course, there's other ways to hedge. Of course, a popular way is inverse ETFs. YieldMax is actually coming out with their own inverse ETF for ULTY, which is going to have the ticker symbol SLTY. But no one knows when these comes out. It does take a long time for them to go live, but this is in the making, and it's going to have short exposure to those stocks and is not really meant to be a long-term buy and hold. If you're trying to hedge your ULTY position, buying some SLTY will help with that, because if the underlying shares of ULTY go down, then this value of SLTY is going to increase, as well as paying you weekly income. Absolutely amazing, and can't wait for this ETF to come out. And as we mentioned earlier, there are some inverse ETFs. One in particular is going to be VXX, which is basically VIX, the volatility index. And overall, when market crashes, we can see this ETF rise in value. As we saw last Friday, it is actually up 8%. So you would have made a lot of money holding shares of VXX, which is very nice to see. There are also some others, such as SQQQ, which is going to be short QQQ. And we also have SH, the short S&P 500, and we can see it's up plus 1.66%, which is the opposite of what happened with SPY, the S&P 500 index. So we can see that there's a lot of these types of ETFs that provide short exposure, which can help provide hedging against your portfolio, especially with a ton of uncertainty that is going around right now. But one thing is certain, right now, as volatility increases, that can actually increase the premium that we're receiving from the underlyings, especially in ULTY. So you're going to get those weekly paychecks coming in, and the volatility could actually be a good thing, especially if the market doesn't crash too bad. And in one of our previous videos, we went over MSTY, how it had very low volatility. I picked up some more shares of MSTY. I do think there's an opportunity there. Of course, this is not financial advice. I don't want you guys to follow what I'm doing. But as volatility increases, MSTY's distributions are going to get larger, which is something that we haven't seen in the month of June and July, which had its lowest distributions. A little bit disappointing, but I do think that volatility will come back later, and there's a nice opportunity to make some pretty nice distributions from MSTY again. But of course, ULTY is the flavor of the year. It's been paying out dividends distributions pretty consistently. As we can see, it's been paying between 8 to 9 to 10 cents per share every single week ever since March, which is very nice to see consistent payouts. And I would love to see ULTY continue this pace going forward, But of course, ULTY isn't perfect. The protective puts limit but do not eliminate the downside exposure, and a major sell-off on the underlying holdings that it has could still erode NAV even with those protected puts. So in conclusion, be careful with the volatility that we're going to be seeing next week in the market, and just remember to have cash on the sides because these dips provide amazing buying opportunities. And most of the money made is actually when the market crashes and people are buying in rather than selling. And this is why it's very important to not put your entire portfolio into a single stock or ETF and to have some cash on the side for opportunities just like these.